Alright guys, in today's video we're talking about order blocks. This is a long awaited video. I know a lot of you have been really eager to hop on this one, so let's get right to it. So as you can see, we're starting off with the ebook, the Currency Pros ebook, which is the full strategy ebook. It's available within the Discord membership in the resources section. And the reason I have it up right now is that it really describes everything step by step. There's a lot of points here that I'd like to go over before we take a step forward and go into the chart on TradingView for real live examples. Okay, so let's get started here. Now, before we dive into the examples on the ebook, I just want to quickly go over what are order blocks. All right, so an order block is basically the last point in time where institutional money, the last point in time before institutional money enters the market. So let's go over this briefly. Institutional money enters the market algorithmically at key levels in increments known as order blocks. Now, the reason for this is that instead of entering hundreds of millions of dollars in currency into the market at once, institutional orders are broken up into multiple entries, creating tight consolidations that we see right before an impulsive movement in the market. This method leaves an institutional footprint on a chart that can be identified and capitalized on. So in simple terms, it's basically like supply and demand, but just very refined. That's basically what an order block is, okay? It's supply and demand concepts, but the term itself is just describing a more refined approach to supply and demand. So if we take a look at the example right here, as I stated in the ebook here, this is the institutional order block, the entire thing. And in this bullish leg, of course, this would be a demand zone. So again, it's kind of the same thing. This is just a different way of categorizing it and a more refined approach as we go forward with the methodology, right? So this whole thing is the institutional order block, all right? That is the point in time where institutions are entering the market in smaller increments, building up orders repeatedly until huge momentum kicks into the market. So this is the footprint that we look for. We look for this consolidation and then the impulsive phase following it. And this is the area that we target for our retracement. Like as price comes back down, it wants to mitigate the orders left open at that zone to make sure there's equilibrium between buyers and sellers. And then it typically takes off in the same direction after mitigation, okay? Now let's jump back to here. Oops. So I wanted to go over this paragraph right here. The most important thing to understand about these institutional orders is that there is no protective stop loss being used. Okay, that's a very important thing to remember here. There's no stop losses being used when it comes to institutional money. And keep in mind, they're not actual traders. It's not an actual person sitting at a desk per se, but these systems are designed algorithmically. So they don't trade with stop losses. Because obviously the pockets are so deep, they can withstand massive, almost incomprehensible drawdown, right? Now, in order to mitigate that drawdown, in order to stop that at some point, price has to come back to that point, right? So if all the orders are building up here and then price takes off, these are buy and sell orders that are building up here, right? So they move price in one direction, profit on that way, and then all the sell orders that they had built up here, price is going to come back down, retrace back down to that zone, tap into there so that all those sell orders can go back to break even instead of being in a drawdown. And that's why once price gets mitigated, we take off from that point on in the original trend direction, right? Because the trend has already been established. They need to mitigate the orders that were still left open in order for them not to have long-term losses and drawdown, right? So that's basically just a short form of what order blocks are and why we see them in the market. Now, of all the strategies that I'm aware of in the market, all the Forex trading strategies, even stock trading strategies, even crypto, this is the only thing that truly explains why, okay? This is the only thing that really explains it. So this is one thing I pointed out here in this paragraph as well. So during this process of order block mitigation, retail traders are busy focusing on double tops, flags, Fibonacci, moving averages, and other indicators that have nothing to do with why price does what it does, okay? That whole sentence there is very important. This is the only thing that really explains why we're seeing what we're seeing on the chart, okay? Whereas most traders are looking at things like, this is a bull flag, right? That doesn't explain why it's happening though. Why is there a bull flag happening, okay? None of these strategies explain why price is doing what it's doing, especially to the accuracy that smart money concepts and refined supply and demand concepts provide. It's just absolute clarity, and that's what allows us to trade with such precision, because we know where is most likely the market's going to move to and why it's going to move there specifically. So with that being said, let's move forward a little bit. Right, this is the part I wanted to go over next in the ebook. So how to trade order blocks. We first identify the point of interest, which is the entire zone at first, but then, as we've learned about in the supply and demand section of this course, we can refine the zone down to the last candle. So in this bullish leg here, in this bullish scenario, it's the order block itself is the last bearish candle before the bullish move, okay? So in this example here, it's very clear. We have that small bearish candle, and then price takes off very impulsively, creating imbalance in the market, a lot of inefficient price action. And so this is the last point in time before institutional money took off, okay? This is what I like to refer to as the point of origin. That's what I call it very often. It's always best to locate the point of origin for the move. And that's why there's a lot of confusion with order blocks sometimes, because people don't understand where to target. They'll say to me, okay, what about this bearish candle? What about this bearish candle? What about this bearish candle? Which one is the order block, And my answer is always the same. What did that candle do? Okay. What did this candle do? What did that candle do? It did nothing. This candle, however, this last bearish candle was the point of origin for this move. It caused this move, okay? Or it was at least it didn't cause it, but it was the last point in time before the move happened. So it's the point of origin. And that's why it's important, and that's how we refine our order blocks down from time frame to time frame. So on a 4-hour time frame, you can select a big order block and keep going down the time frames, do top-down analysis, and refine it to the true last point in time before the move occurred, right? It's actually a very simple process once you get the hang of it. It just takes a little bit of time to train your eyes. But that's why I've included this whole ebook within the Discord community, because you can download it and keep it for life. Anytime that you forget something, you can, of course you can watch this video again, but some people are more visual learners like this. I know some of you have printed it out and like to keep it at your desk. That's super cool, and I think that's going to be really helpful for your trading, because if you ever forget things like this, you can always just dive into this, look over the things that I've written here, and at the end of the book, there's a very important summary as well, okay? And the summary basically is a step-by-step process to locating and trading order blocks. All right, so let me just go through this step-by-step, because I think it's very important that I articulate what I've written in the book here, and then we'll go into the real chart examples. So once we've identified the point of interest, we refine our zone down to the last opposing candle prior to the impulsive move, as I just explained right here. In this scenario, we have bullish momentum and we are looking for buys. We need to identify the last bearish candle prior to the bullish move. If the surrounding candles and wicks are all small, it's best to include them as well. So what do I mean by that? Well, as you can see here, my rectangle tool that I've placed, it covers the bottom wick of the next candle, but it doesn't cover the top wick of the order block itself. Now, why is that? Well, that's simply to achieve a better entry, plain and simple. Oftentimes I will include the wick if it's small enough and just have the entire rectangle tool engulf that whole area. You'll find that you get triggered into trades more often like that. I just like to go for extremes more often because it gets me tighter entries. So oftentimes I'll go for the open of the candle, which is right there, the top of that bearish body. But then just to be safe, to be protected, I'll drag the rectangle tool down to cover any wicks just surrounding it, because that's where my stop loss would be around, right? So I don't want to get too tight with the stop loss. I want to get as tight an entry as possible, but I want my stop loss to be safe, right? So that's why I said if the surrounding candles and wicks are small, it's best to include them as well. So let's continue. This is the last area of institutional activity prior to the impulse. This is the area where a hedge position may be mitigated before continuing bullish momentum, right? So this was the point of origin for the institutional move, okay? Where volume really kicked into the market, momentum really kicked in. So we know that it's a very high probability price is going to retrace back to this exact point to mitigate any remaining orders there, opposing orders, right? So there's buy orders kicking into the market, obviously, but within this huge consolidation, there's also a bunch of sell orders placed by institutional money, sorry. So those need to be mitigated, and this is the last point in time before momentum kicked in. So we know that that's the highest probability place that price is going to retrace to mitigate those orders. So now in the ebook here at the beginning, I didn't go over entry styles or anything like that. It's later on in the book that we went over the risk entry versus the confirmation entry. We're of course going to do videos on that as well. So I'm really not going to dive into that too deep. So to keep things simple, at the beginning of the ebook here, when I was starting to get into order blocks, what I did was just set an example of a risk entry. And basically the risk entry, just to briefly go over it, is when you simply set a limit order. So in this case, a buy limit order, you simply set that right at the point of interest. Okay, so this would be the open of that bearish candle right there. You see how that line lines up with my position tool over here? That is the buy limit entry. Excuse me. And as you can see, the stop loss in this example is placed just below that rectangle tool. And so this is what I mean. I wanted to cover that wick just in case price needed to go down there and potentially create equal lows, which wouldn't be ideal, but you just want to be safe anyways, especially because of spread, depending on the broker that you're with. You don't want to have things too tight. So you want to give it a little bit of breathing room. So I never place it right at the rectangle tool. I place it usually 1 to 2 pips below the rectangle tool. So there's my stop loss, there's my buy limit entry, and the take profit in this very simple rudimentary example is set at most recent highs right here. So that's a pretty healthy risk to reward ratio, right? And so this is the risk entry. We simply set the order and wait and see what happens, right? Now, of course, we trade a little differently than that with our confirmation entry, but that is not for this video. So let's continue forward. Now, as I wrote here, the tight stop loss may look intimidating. However, we do not get emotional. The reason I say that is because we need to trust our analysis, right? We can't be thinking, oh, the price needs room to breathe. You know, that's a typical thing that a lot of traders will say. They'll set like a 20 to 40 pip stop loss because they'll say just in case price needs room to wiggle around, right? Now, you'll see the difference between that and what I just went over is I only set the stop loss slightly below, like 1 to 2 pips below, and that is simply for spread, okay? It has nothing to do with me giving price room to breathe. It's simply, I've encountered situations before where the spread changes with the broker, and it can actually stop you out of a trade prematurely, and nobody wants to deal with that, especially when the trade ends up being correct anyways. So you want to give it a little bit of breathing room, but not because you don't understand price action, just because you want to be safe with your broker, okay? That's all it is. So we do not get emotional because we trust our analysis. We know that this is the point in time that, this is the last point in time before institutional money kicked into the market and volume was brought into the market with heavy momentum. And that is the point that needs to be mitigated, okay? So if price barrels through this zone and invalidates this order block, then that means we were wrong, and maybe we overlooked something to do with our analysis, and we need to reassess our analysis, right? So that's the thing. The stop loss is there for a reason. It's to prove you wrong if you're wrong, okay? And to protect your capital, of course. But if my stop loss gets hit, to me, that means I'm wrong and I need to adjust something, okay? So I don't need to have a stop loss way down here. I only need to have a stop loss at a point where I would be proven wrong, okay? It's very important to remember that. So Yeah, I wrote that up here as well. We know that if our stop loss is hit, our analysis was wrong, and that it's time to reassess the market for a new entry, wait for a better setup, or simply move on to another currency pair. Okay, we don't get emotional about it. Now, in this scenario, this position was triggered perfectly with only 2 pips of drawdown, resulting in a massive 10.77R profit, a textbook example of order block mitigation and continuation. So as you can see, price retraced in a very corrective manner, just tapped into the entry, a couple pips of drawdown, right? A little bit of drawdown, but we tapped right into that order block, and then look at the impulsive momentum that kicked in right after that. That is because price took a pit stop, gathered some fuel, right? That's all this is, just gathering fuel at a pit stop. The order block is the pit stop. Once it gathered fuel, it floored it, stepped on the gas and took off, right? So as previously mentioned, it's best to locate order blocks on higher time frames. However, that leaves you with a very large range to place your stop loss. And with this strategy, it's really not necessary to have any stop loss larger than 10 pips. Me personally, I like to stay around 3 to 5 pips. That's kind of my sweet spot. I don't really go below 3 pips. That's just a little too risky for me. Now, in order to shrink the gap between the entry and the stop loss, we must refine the order block by using lower time frames, right? So that's basically what I was going over earlier. You can find an order block on the 1 hour time frame or the 4 hour time frame, let's say, but that's going to leave you with like typically a 20 pip stop loss or maybe a 10 to 15 pip stop loss, somewhere around there. And if you want to get it lower, you either have to split it in half with a Fibonacci tool using the 50% mark, or you refine down to lower time frames and continue to shrink your rectangle tool until you find the true last point of origin. And this can go down all the way to the 1 minute, the 30 second, the 15 second. It depends on your style, but all you have to remember is that the lower you go, the less chance of it is to be triggered, right? The lower time frames require other skill sets that we're going to go over in future videos. Me personally, I like to locate my order blocks on the 1 hour time frame and the 15-minute time frame. That's the 15-minute is kind of my minimum, right? And once price reaches that order block, that's when I'll drop down to the lower time frames and look for my confirmation entries, because I don't trade these risk entries very often at all. It has a lower win rate. It's still an extremely high probability strategy, and it works out well for a lot of people. Not everybody has the time to sit around at the charts and wait for confirmation entries on low time frames. So a lot of people just utilize this method. But me personally, like, I'm a full-time trader, so I'm happy to wait for price to enter the order block and then go down to the 1 minute time frame and get an even tighter entry than this, right? But we can go over that in future videos. I go into the refinement process a little bit here. Not too much to go over, but we'll quickly go over it. So basically, when you locate a point of interest on a high time frame, let's say the 4 hour time frame, and then you drop down to, let's say, the 1 hour time frame, it's going to look something like this, right? Instead of one big bearish candle like it showed up as on the 4 hour time frame, it's now going to be shown as 3 bearish candles or 4 or something like that, right? Because basically when you go down a time frame, you're just zooming in and zooming in and zooming in. So that big bearish candle is now 3 bearish candles. So what you can do, as I showed in this example, is shrink your point of interest with the rectangle tool, shrink it down to the last candle right there. So we shrunk that zone more than half, right? And that gives you a nice tight stop loss to trade from. Okay, we're not going to go over entry types just yet, so that's for another video. But yeah, I mentioned that briefly here. Let me find it. Right, so by doing this, we drastically shrink our zone from 24 pips to just over 9 pips. So you can see how much of a difference that is. This point of interest or order block was located on the 4 hour time frame, which is a bit high for me, to be honest. But once we drop down to the 1 hour time frame, we see that it's actually comprised of many smaller candles. So we can refine that down to the actual point of origin, right? Which is that last small candle there. So we more than half shrunk our entry parameters, and that gives us a much tighter stop loss and of course more profitability when price works in our favor and hits the take profit, right? So that's about all I wanted to go over with the ebook. Just a general just a general idea of what order blocks are and how we can utilize them. And now we're going to dive into some real chart examples. I prefer going over the charts because I can move things around and really annotate with my mouse. So let's go into that. All right, so we're here on Australian dollar, US dollar on the 1 hour time frame. Now there's a really great example I'd like to go over here with you guys. So one of the concerns that most people have when they first start to learn this type of methodology is that they understand the basic concept of the order block, but what happens when they learn about order blocks is that they start to see them everywhere, okay? And don't stress, that's a very common thing and it's perfectly valid. And I'm gonna show you why. So if you've read the ebook, you should know this especially. An order block is created when there is a break of structure, right? We have to have a break of structure in order to locate an order block, okay? Because we need to know that our order block is responsible for an actual move in the market, an actual structural change, right? So technically, in this bearish leg, right, we have clear bearish order flow. Within this bearish order flow, we have multiple order blocks that we could target. All right, so I'm going to highlight a couple of them for you. There was one right here, right? That small bullish candle. I know we wicked into it, but it's hard to say if that was because of a broker or what. Like it could have been a news event. That's not always valid. A long wick like that is not always valid. So I'm still going to highlight that order block there. Now we have another order block here, right? That doji candle, that indecisional little pin bar kind of candle. Now, before I get too ahead of myself, let me also annotate the breaks of structure as I go along. So there was a break of structure here. Reason being, we had a low point here. Price failed to make new highs, and then it crashed, impulsively surpassing this structural low, okay? Very simple, break of structure. Now, we're on the 1 hour time frame, so this is kind of clustered. If you were on a 15-minute or 5-minute, this would look a little more clear. Actually, let's just quickly do that just so I can annotate this a little better. Right, so the reason I highlighted this is because we have another low right here. Price retraced, failed to make a new high, and then impulsively broke through again, breaking that low, okay? Very simple. Again, another break of structure. Let's jump back to the 1 hour because I want to stay on the 1 hour for this specific example. We'll go over more examples later on, but for now we're going to stick to this on the 1 hour time frame. So again, this is the second order block here. Now we have another low point here. Price kind of bottomed out there, pulled back, failed to create a new high, right? We didn't surpass this high or this high or this high, so it failed to create a new high and then plummeted again, breaking structure, okay? Again, very simple. Break of structure concept is extremely simple to understand. It just takes practice. I suggest marking it up on your charts any chance you get so you can really get used to the idea of prioritizing breaks of structure, okay? So we'll put that there. I'm not going to mark out this one because it's just very clustered on the 1 hour time frame, but we did go over that, so you know it's there. So because of that break of structure, what's the point of origin? This bearish candle right here. Mark it out, right? Technically, it could be refined down to this little candle here, even though it's a bearish candle and not a bullish candle. The colors don't really matter. That's another thing I'd like to go over. The colors really don't matter. All that matters is that it's a low momentum, low volume candle prior to the impulsive move, right? So let me zoom in a little bit more here. That would have been valid as well. And it printed right after. Yeah, so. And that did get mitigated. As you can see, price wicked into it and then traded much lower. That right there could have been a pretty decent trade. But eventually price retraced much higher than that, which would have taken you out at break even or what have you. The point is, I'm trying to map out these order blocks so you can see how many are actually here and how many are actually valid. Okay, so let's just keep going. You'll start to understand when I'm done this. So there's another order block there. Technically it could be refined down to this one here because that was the last low momentum candle prior to the bearish move. Now we didn't see a full break of structure. We didn't break these structural lows. However, we broke this structure, which is a minor substructure. So what I would do in this case is MBOS, minor break of structure. Just label it like that. So you can see how many are actually here, right? Now, at this point in time, my chart is right here because this is the example I'd like to go over. My point with all of this was just labeling how many valid order blocks are actually here, right? There's quite a bit. So I can see why people get confused, especially when they don't all get mitigated right away, okay? The market doesn't just move in perfect motion like this. It's never like that, or at least it's very rarely like that, okay? It never works like these line graphs that people share all over Instagram. It's very imperfect in that sense. So my general rule of thumb is to follow most recent price action, okay? So we had this order block. It may have been mitigated with this wick, hard to tell because again, I don't know if that was from a broker or from news or whatever it may be. We have this valid order block here, never got mitigated, right? Price made it up to here, still quite a ways away. We have that gap there in between. So that never got mitigated either. This one technically did get mitigated here, but that would have been a loss. Obviously, there's no trade there. This more recent order block, you could have taken a very small trade, maybe like a 4R, 5R trade there, depending on where you entered. Right? So as you can see, not all of them are mitigated. Some of them are mitigated, and then some would provide even a losing opportunity potentially. So it's most important to focus on most recent price action, okay? This one hasn't been mitigated either. And my point here is that I stop paying attention to these when something new happens in the market, okay? I'll leave it on my chart for future reference. If there's an unmitigated order block, it's good to have on your chart just so you're aware of it in the future. But I'm paying attention to most recent price action. And so what do we see in most recent price action? Well, we had a low right here, right? This is our lowest low of this entire bearish leg. And price impulsively broke through it. Okay, so we have a clear break of structure here. So at this point in time, I need to find the point of origin for this break of structure. I'm not worried about the minor break or this break or that break or any of this nonsense, right? I'm only concerned with the most recent price action developments, which is this break of structure. So let's follow the candles back up. What's the point of origin here? Nope. Yes, this one right here, this bullish candle. That was the last opposing candle or low momentum candle prior to the bearish impulsive move that was responsible for breaking this structure, okay? So this is the most recent move. This is what we're gonna target, right? If you woke up at 7 in the morning, let's say, for example, and this was all in the past, what are you going to do? You're going to target most recent price action. You're not going to sit on your chart for 5 or 6 hours hoping that something else happens. You're going to focus on most recent price action. So for the sake of this example, let's set up a position in the style of a risk entry, which means our entry point is right at the beginning of our point of interest here, our order block. And another point to mention is I did enclose both wicks in this candle just because they're fairly small, so I figured it's probably best to just include that whole thing. Stop loss just above. Now I usually keep it just above the rectangular zone, but in this case we have a wick here as well, so I will keep it just above that wick. Now of course this is 17 pips as a stop loss. That is way too much for me personally, but this is just an example. I wouldn't necessarily take a trade right off the 1 hour time frame. I typically take trades from the 1 minute or 5 minute, But again, this is just an example to show you how order blocks work and how we can utilize them, because the methods that I'm teaching you on this time frame work for every single time frame, even if you have the 30-second or the 15-second or the 5-second, even the 1-second time frame. It's all the same thing. The market is very fractal. So whatever you see on the higher time frames, even weekly, daily, 4-hour, it's the exact same as these, just at different scales, right? So we have our entry set, we have our stop loss set. This is our order block that we're targeting. Our take profit, in this case, I would like to target the most recent major low, which is right here. I have it marked out with a ray line. And so if we drag the take profit tool down to there, that leaves us with a potential 8% profit if you're risking 1%, or just regardless what you're risking, this is an 8R trade, okay? So for every dollar that you're risking, you would gain 8 in return. Now let's see what happens here. Let's see if this order block is respected or if something else develops. Now, before I continue, if we were to not mitigate this order block and we were to just kind of stall out here and start trading downward again, well, then we would create another break of structure, right? And then I would simply target the order block responsible for that move, okay? It just keeps going over and over and over again. You don't have to mitigate every single one of these. They'll all get mitigated eventually if they were left unmitigated, because when price reverses at some point, it will clear all of that, okay? So that's one important thing to remember. They don't all have to be cleared one after another. All that matters is most recent price action if you want to trade, right? If you want to be a trader and get in on price action, you have to focus on what's happening in front of you, not what's happened in the past, okay? It's good to be aware of it, but the focus has to be on recent price action. So like I said, if we were to not mitigate that and we were to just break structure again, I would simply target the new one. And if that didn't work out, right, if we had a break of structure, I was targeting the order block, but it just didn't get mitigated, and we had another break of structure, well, then I would just target that order block instead. It just keeps going and keeps going. There should be no fear of missing out in the market, because the market continuously prints new opportunities. Now, with that being said, let's play forward this position we have here and see how it plays out. Let me just go slowly to see if and when it gets triggered. Okay, so this is interesting. Let me move this over. So the trade does get triggered. Now you might be thinking, this is a break of structure too. Technically, it is. On lower time frames like 5 minute or 1 minute, it would look like more of a break of structure. However, you can see how the body pretty much didn't close below that low, right? The body is pretty much in line with the previous wick low right here, and we just simply wicked under it. So that could be clearing liquidity, which of course we're going to go over liquidity in future videos of this course. But basically liquidity is built up orders, built up stop losses, and price oftentimes purges that liquidity. Many of you may know it as stop hunts or fake outs, retail terms such as that. It's really just liquidity. It's the market algorithmically doing what it was programmed to do. Okay, so if there's liquidity sitting here, we just purged liquidity and then continued back up, confusing the hell out of people, right? So I wouldn't really consider this a break of structure. I like to see full body impulsive candles such as this to signify a break of structure, right? Now, you might be also thinking these ones weren't very impulsive. That's correct, but they were followed by this very impulsive candle. The momentum was still there in the market, and we did have a body close below this low, right? This body closed below. Whereas here, we just pierced below that level. We just wicked through it. So that's not a very valid break of structure in my opinion. So overall, this trade idea still remains valid, okay? So now let's play it forward and see how it plays out. Okay, so looking healthy so far. So we tapped into the trade. We actually mitigated 50% of that order block. So what I often do is I'll set my order to 50% of the order block instead of the open of the order block. And what that does is drastically change the risk to reward ratio. The only thing is sometimes you miss trades because price does not always need to mitigate 50% of the order block. So this is oftentimes what I do, but it doesn't always work out, right? So you can see how you go from a 13.44 risk to reward ratio down to just over 8 risk to reward ratio. That's the difference that it can make by using the 50% method. But for this example, let's just keep it at the original place that we set it to, which is the open of the order block. Now, in assessing the health of this trade, we have a clear break of structure, right? Price impulsively broke structure, not with a wick, but with a full body candle. So we can see that this trade so far is healthy. Let's continue to play price forward. Another break of structure. If you really wanted to scale into your trades, here's another order block here, right? Which also got mitigated. That is a valid order block because it was the point of origin for this proper break of structure, right? So that's an order block right there. Again, showing that this trade is just healthy. Let's speed this up a little bit. Okay, so if you were to scale in here, that would have been a small loss. That's okay. That happens. Let's delete it to declutter the chart. Move our position tool over because the trade is still going. Now again, assessing the health of this trade, we have another break of structure. If we continue to see breaks of structure to the downside, that signifies that bearish order flow is intact. So I would have full confidence in staying in this trade. You could even trail your stop loss to here or here, right? Above the structural highs, because we now have another order block sitting right there, another scale-in opportunity potentially. Let's continue to play price forward. Okay, see, that was another valid scale-in right there. This order block here was mitigated, so that would have been another valid entry point. That order block was responsible for this break of structure. Price retraced to it, mitigated it, and then melted away once more. Okay. Yep, there we go. Full take profit. Again, if you targeted the 50% of the original order block, this would have been almost 13.5 R. So if you're risking 1% on your trade, this would have been about 13.5%. So that's pretty phenomenal. But even just targeting the open, that's 8%. So again, phenomenal. So this was a really good example of how to utilize order blocks. We even got a scale-in opportunity there, right? So if we had our initial 8% and then targeted this as well with the stop loss just above, targeted the same area for profit, that would have been 11% on top of the 8%, so 19% total, which would have been phenomenal, minus the 1% or the 1R loss that you would have taken on this order block, because this was a valid order block. However, it would have gotten stopped out. So overall, you'd still walk away with about 18% in this total trade, and that is absolutely phenomenal. So before we move forward, I just want to clarify that this takes a little bit of time to really train your eyes to, but I really do advise you to consistently label these BOS, break of structure, and even minor break of structure, as well as highlighting your order blocks with a rectangle tool. Use whatever colors you want, whatever appeals to you most. But the more you put these on your chart, the faster you will train your eyes and train your mind to spot these opportunities. And then before you know it, it's going to become second nature, okay? So I hope you enjoyed this example. Now let's jump back to the ebook because I want to briefly go over the summary at the end of the book, okay? Let's do that now. Okay, so we've gone over quite a bit of important notes today on order blocks. Now, I wanted to briefly cover this summary at the end of the ebook, which you all have access to. The reason I did this is because I know that when you learn something new, it can take some time for it to really become ingrained in your way of thinking and approaching the markets. I also know that emotions can run high when you're new at trading, or even experienced at trading for that matter. It just depends on the day you're having, right? You might be having a stressful day and you just want to see some profit already. And oftentimes those emotions can, unfortunately, throw some knowledge out the window. Like sometimes you'll just forget basic things that you know you should be practicing because your emotions are running high. It depends on the situation, but basically that's why I created this summary here. Because whenever you're feeling off or whenever you're, unsure about something, you can just refer back to this. So let's just briefly go through this step by step, just to provide some more context to this summary. So step 1, gauge the trend direction and locate a significant break of structure on higher time frames. For example, the daily, the 4-hour, and the 1-hour. Now I put these here just to be general, but again, me personally, I prefer the 1-hour and the 15-minute. It's just different for everybody. Like I'm more of a day trader, sometimes even a scalper. I like to be intraday in and out. If you have longer term goals, maybe aim for the 4-hour or the daily. Like I said, these concepts work on literally any time frame, so it's completely up to you. That's why there's no general rules like this. It's all up to personal preference, okay? So again, gauge the trend direction, right? Figure out if it's a bullish or bearish order flow, and locate a significant break of structure, BOS. So the significant break of structure means a break of structure that was created by impulsive full body candles, okay? Not wicks, right? Because that's not very valid. That's not a high probability setup, but you want to see a clear break of structure with full body, high momentum candles with lots of volume in the market, okay? That shows the institutional footprint. So that's the significant, right? Significant is the keyword, break of structure, significant break of structure. Step 2, identify and highlight the point of origin responsible for the break of structure. This is your order block candle, okay? Again, very important step here. Once you've located this significant break of structure, you have to identify and highlight the point of origin that was responsible for that break of structure. That is the order block, okay? The OB. That's all it is. And again, order block is just another term for refined supply and demand, okay? But this is very important stuff, okay? All an order block is the point of origin that was responsible for a break of structure. Step 3, confirm that the order block caused the break of structure, okay? This kind of goes back to just, understanding if it's a significant break of structure and then finding the true point of origin, the actual last candle, okay? And I briefly mentioned this before, but it doesn't have to be a bullish candle in a bearish scenario. It doesn't have to be a bearish candle in a bullish scenario. It really doesn't matter what color the candle is. That's why some people just have one solid chart color instead of different colored candles. It's all down to personal preference. It doesn't matter if it's bullish or bearish. All that matters is that it's a low momentum, low volume candle prior to the momentum and volume pushing into the market, okay? I probably should have clarified that here. I may edit that in the future, but it really doesn't matter if it's bullish or bearish. I guess the reason I didn't clarify that is because it's maybe easier to identify an order block when it is the opposing color. It just kind of sticks out a bit more. So to be fair, that's probably what I was thinking there. But once you get more used to identifying the order blocks, just know that it doesn't have to be an opposing candle. It just has to be a low momentum candle prior to the momentum kicking in the market, okay? That's the true point of origin. All right, so another thing here, there is added confluence if the order block created significant imbalance and or cleared liquidity. So of course we're going to go over this in future videos. However, there is a section on liquidity. There is a section on imbalance within the ebook here, which you all have access to. So if you're watching this before the other videos are out, then just head over to the ebook and briefly go over the imbalance and liquidity sections of the ebook, because it'll explain basically what that is. So again, all that matters to locate the order block itself is that it broke significant structure and it is the point of origin responsible for that break of structure. But to add confluence, to create a higher probability scenario for yourself, It's a more valid order block if it created significant imbalance and or cleared liquidity, okay? Those are added confluences. Step 4, determine which entry style best suits the trading opportunity, a risk entry or a confirmation entry, okay? Again, if you're watching this before those course videos are out on entry styles, there is a section within this ebook, confirmation entries, right? Entry types. We have a lot of information in this ebook. This thing is jam-packed with value, okay? So just refer to those for now and then watch the videos afterwards. So again, determine which entry style best suits the opportunity. Typically a risk entry is more suitable if you have a busy day. You want to get in on a trade, you don't want to miss out, but you have a busy day ahead of you. You have to, you have family shit to take care of. You got to go to the office, whatever the case may be. A risk entry is good for that because it's kind of the set it and forget it methodology. It's also very suitable if price is very correctively approaching an order block, because then you already know that price is slowing down, it's losing momentum. So there's a higher chance that it's going to stall out at the order block and reverse from there. Whereas the confirmation entry is much safer because you can literally watch price approach the order block, hit the order block, and then you wait to see if it rejects or pushes right through and invalidates the order block. So there's a huge difference. You have to determine which entry style is best. Me personally, I pretty much only use the confirmation entry. I rarely take the risk entry, and when I do, it's usually a loss. Like I used to trade those a lot at first, quite some time ago, but as you get more experience with the strategy, the confirmation entry just makes the most sense. Unless you're super busy and you only have a short amount of time per day to place trades, then you should probably refine your risk entry methods and just continue with that. So step 5, set your order at the desired level, place your stop loss just above/below the order block, and place your target profit at the next order block or most recent structural high/low. Step 6, which is the last step of this summary, manage the trade responsibly by securing partial profits along the way and or moving your stop loss to your entry point to eliminate risk once the trade has progressed significantly. All right, so if you're targeting a big like 10R trade or a 15 to 20R trade, something like that, don't just enter the trade and then hope that it gets there, okay? Oftentimes crazy things can happen in the market, whether it be driven by global events or economic events, what have you. Unexpected things can happen. That's just the nature of the market. All we can do is react to that. So it's very important to trail your stop loss. So for example, whenever there is a new break of structure during your trade, you can trail your stop loss just above that break of structure and the new order block, right? The new order block that's created by the new break of structure. So that's one way you can do it. Or you can set multiple structural points throughout the trade. And as price reaches those structural points, you can simply remove part of your position size with whatever execution platform that you're using. You can, for example, remove 50% of your position when it gets to halfway to your profit, and then leave the other 50% to run to the final take profit. And of course, remove your stop loss, like move the stop loss to break even or trail it, something like that. You got to just be responsible, okay? You can't just hope for the best, or you're going to see more losses than you do with wins, okay? Because even when a trade makes perfect sense, sometimes, like I said, a news event or some sort of global event can spike the market in the opposite direction, even if it's just temporarily. That can completely screw up your trade and leave you very frustrated. So it's important to manage your trade responsibly, okay? So I hope you guys enjoyed this video. This is a really important one. I'm really happy I got to go over these points for you guys, and I hope you guys watch this a bunch of times as well as go over the ebook a bunch of times. I spent a lot of time creating this and really curating it for experienced and inexperienced traders. My goal is that it suits everybody and acts as a good directory to refer to if you're ever struggling in the market, okay? So this page is one of the most important pages in the whole ebook and on order blocks in general. This is literally a step-by-step strategy. This is a full strategy right here in 6 steps. Of course, there's more nuances to the method that we trade, which is the whole purpose of the video course, because we're taking a deeper dive into things. But just rest assured, this page right here, these 6 steps, this is an entire trading strategy right here. So just keep that in mind, refer to it as much as you'd like, even print it out, laminate it, keep it on your trading desk, whatever suits you, okay? So I hope you guys enjoyed this video, and I'll talk to you soon.